Hey there, folks. I'm Bryce Holdaway, host or co-host of the Property Couch podcast. And today I have with me a very special guest, a returning guest. We are chatting with Nerida Conisbee, the Chief Economist at the REA. First of all, welcome, Nerida.
Thanks for having me.
Hey, it's a pleasure. Thanks for joining us on the couch all throughout the year. Your insights are very much valued by our community, and I'm excited to sort of talk to you about a little bit of a rear vision mirror look at the year that we're all sort of running as hard as we can to New Year's Eve to tick off. But also at the end of our chat today, I kind of want to get your crystal ball out and have a little chat about what we think 2021 might bring. But we're officially out of the COVID recession, and despite some early predictions of 30% drops, there's been minimal declines across most of the markets, and in fact growth in a lot. So is that as you expected?
Look, it's far stronger than I expected. You know, I think when people started coming out with a 30% drop, it did seem extreme, you know, even at that stage, because right from the beginning, we always knew this was a productivity problem. You know, people couldn't work properly, but at the same time, banks were doing okay. So, you know, we had a lot of liquidity, interest rates remain low, very different from previous recessions where access to finance was a big issue. So we were never going to see 30% price falls. But, you know, as you said, it is surprising that we've come through this. And you know, in Sydney and Melbourne, we saw tiny drops in around May, June. If you have a look at the rest of Australia, it's pretty much been full steam ahead all the way through COVID.
Can you put your finger on why so many economists tend to, and I know you want to protect the alumni of The Economist, but, you know, you've got your fingers on the pulse. You're in the number one portal for property in the country. So therefore, it makes sense that you had a sober and measured view around property. But why do you think so many experts were going down that path? And these are smart, intelligent, articulate, well-informed people around that, because they're all scrambling now to update their predictions for growth. I don't want to cut their knees off, but is there something fundamental that you have an advantage of being at the coalface that they don't? Where do you think that mismatch might be?
Yeah, look, I mean, we certainly could see quite different behaviour than what people were saying. You know, there was a lot of talk early on about how demand was drawing back, and, you know, demand is, you know, it's very hard to measure, but, you know, in terms of what we could see in terms of search activity, we definitely saw a big drop in the first couple of weeks of the lockdown back in March. But, you know, we then did see things tail back. We also were seeing a shortage of stock. So, you know, that's another thing that, on one hand, even if you do see a drawback of activity, which we weren't seeing, if you see a lot of stock hit the market, then that's a problem. I think where a lot of people got it wrong was that they were looking too much at the employment impacts as opposed to the capital market impacts. And, you know, and it's not surprising. I mean, if you have a look at people when they buy property and they become unemployed, it's highly problematic to pay back a loan. And, you know, I guess it makes sense that, you know, we could have possibly seen high levels of distress. What didn't happen, though, was that the banks didn't collapse and they didn't go into distress. So they were able to really help people through this process. So really those 6-month mortgage payment freezes really helped people who, you know, were starting to feel a little bit distressed. But we also saw a lot of government stimulus as well, which really helped out. And then of course, the interest rate cuts, which were always going to happen. But, you know, I think that was obviously another factor that once that hit in November, it really started to look like full steam ahead.
It's difficult to see the wood for the trees. I can still remember the anxiety and the feeling that we had when it all kicked off. And, you know, you look back now and you go, oh, of course, it only affected a certain segment. And of course, those people were largely in the rental market. But it was, at the time, it was very difficult to discern in the heat of all of that, you know, making sober decisions around something that was globally affecting everyone. It was affecting how you even walked and interacted with the people that you love and your friends. So it kind of makes sense that people can go into that, I guess, that anxiety spin. But I guess history has proven that the residential property in this country, with the fundamentals that we went into the pandemic with, tended to support it. Hey, this weekend, auctions. There's a few around.
There certainly is. We're actually seeing the highest level of auction activity all year this weekend. So completely unprecedented this close to Christmas. I mean, we're only a week out from Christmas once we hit Saturday. So this is this year's Super Saturday, and it does show that we are, heading into a very, very strong 2021 when we see this much activity towards the end of the year.
Yes, very, very strange. So if anyone is watching this, if they could just let us know, are you attending an auction this weekend? Whereabouts are you attending it? Are you surprised that you are attending it at this time of the year? So, and if you've got any questions that you want me to ask Nerida, put it in the chat box and we'll see if we can find some time to answer those for you, because it's very rare that we get access to someone with their finger on the pulse like Nerida, so we'll use this time wisely. Hey Nerida, you recently talked about there were 6 reasons why property remained resilient. So I'm keen to explore that for the benefit of our community, to hear your thoughts around this. But the first reason, and I'd love you to sort of flesh out as best you can on each of these points, but the first reason you stated, and you touched on it just briefly a second ago, number one reason, banks are being supportive for now.
Yeah, so the 6-month mortgage payment freezes, as I mentioned before, was a huge factor, and they were pretty much given automatically early on in the pandemic. So I think on one hand that obviously supported people who were stressed or lost their jobs or had to shut down their businesses for a short period of time. But I think it also gave people a bit of confidence. We know that a lot of people took that opportunity to have a mortgage freeze, even if they then, quite quickly went on to repaying things. That September cliff never eventuated. I think that was another one that as we were getting close to September, where there was a big concern there was going to be this big withdrawal of support from government and also from banks. Banks continued to work with people. It was, I suppose, looking back at it now, it makes sense. Banks don't want to be stuck with mortgagee sales and, have customers going underwater in terms of their home loans. And, they obviously, it's not in their best interests. And also the fact that we've just come through a Financial Services Royal Commission, I think it, was really an opportunity for them to show, well, in bad times, we can help people through. Particularly given that we have so much liquidity and money available to us to be able to help people.
Yeah, the lesson is that property's too big to fail. Governments are propping it up. You've got banks that have got a fair bit of incentive to make sure their customers are okay. And also just in terms of the September cliff, it's not like they were going to create all this energy and activity and then go, oh, it didn't work, let's cut it all off. You and I have talked about that before, but I think it's good to reinforce the learning for all of our listeners to go, okay, let's hope we never experience anything like this ever again. But if you're faced with a minor X factor event going forward, you can remember some of the principles and the fundamentals that we've learned through this major X factor event that you can use to learn going forward. So number one reason you said banks are being supportive for now. The second reason you said is unemployment primarily impacted renters.
Yeah, so that was very early on that we saw that. I mean, if you have a look back to April, that was when the 6 months freeze on, people went into distress. They could not pay their rent for quite a prolonged period. And, looking back, it was obviously very stressful for people that were owners of rental properties. That was a big issue for them, but it did help renters through. And what we've seen, what we see in every recession is that young people do get hit more by unemployment than older people, and that's typical with what happens. But this time around, it has been even more pronounced that it is young people that have been hit because they are more likely to be employed in hospitality, tourism, and education. So they're the 3 sectors that are became very challenged very, very quickly. I think what's interesting now, though, is, although we are now seeing prices really start to move across Australia, there's still quite a few challenges in the rental market. And when we have a look at Sydney, for example, 95% of suburbs are now seeing house price growth. But if you look at the unit market, around 3/4 of suburbs are seeing rental declines. So, there's quite a mismatch between what's happening on the tenant side versus what's happening on the pricing side. So, I suppose, coming through this it's not like things are full steam ahead everywhere. There's still challenges, and obviously the rental market is the main one.
Yeah, some of that high density stock stuff that's affected by overseas students not landing, all that sort of thing affects it too. So, so number 2, unemployment primarily impacting renters. Number 3, rental listings have slowed.
Yeah, so rental listings, we're starting to see, we did see a big tick up in rental listings available. And again, that was, really quick in terms of how that happened. So it was, again, partly foreign students not returning. There was a lot of people moving into share accommodation, moving back with parents or with family and friends. We also saw this flood of Airbnb properties into the market. So that was also a factor. So what we have seen now, all those Airbnb properties have gone back to Airbnb. The tourism sector locally, domestically is really powered ahead. And we are so, as I mentioned before, the rental market is still very challenged, but, things are slowly improving. And I think this is one to look out for. We tend to look at strong markets and think, well, that's a market I should be investing in because it's strong. But there's definitely opportunities in unit markets around Australia at the moment, because if you have a look at somewhere like Carlton, Carlton is, close to Melbourne Uni, it's close to RMIT, tons of students, but very challenged in terms of rents, and prices have dropped 20%. But, maybe now that's the time to look at that area. So, I think they're the sorts of things that, although some markets are very weak at the moment, there's going to be some changes in 2021, which could potentially lead to far more stronger conditions.
Okay. Well, there's some insights there, folks. The fourth point you talked about, or the fourth reason, you did touch on that just a little earlier, but some economic sectors are faring well, and you talked about mining, government, and the tech sector, but that's obviously helping underpin confidence in the economy.
Yeah, look, tech has gone incredibly well. If you have a look at share price of pretty much, Afterpay, if you look at what's happened to Xero, even Rea Group, the share price of tech has gone through the roof. So, there's been a lot of confidence in terms of that sector, primarily because there's just been so many changes to the way people work, and it really does support technology. The other one, and I think one of the main impacts of that, it has supported some of the very more high-end property. If you have a look at who's been buying luxury property at the moment, there is this skew towards, very, very well-paid tech entrepreneurs or business owners or whatever. Mining continues to do well. One of the big ones is obviously iron ore, which has seen record pricing. It's seen record exports. It is protected. It's still exporting. Most of it's going to China, of course. But the issue even though we do have a few tensions, a lot of tensions with China at the moment. One of the things with iron ore is that our main competitor for iron ore is Brazil, and Brazil is still hit by COVID, and they can't produce enough. So huge trouble. So we are really pretty much the main option at the moment. So, mining's done well. And then also government, Canberra hasn't missed a beat. To the extent that the Canberra office vacancy rate is actually lower than it was 12 months ago, which is completely different to every other capital city around Australia, where we've seen this rapid uptick in the office vacancy rate.
You mentioned China. I want to circle back to that shortly because I think there's a bit in that, but we'll go through number 5. You said there's less overall spending from households, so that's also helped underpinning. Can you talk a bit more about that, please?
Yeah, so one of the things that's been apparent in COVID is that people haven't had much to spend money on. So no travel, less travel, there's no point dressing up when you're sitting at home all day, and the household savings rate has gone through the roof. So basically, on average, people used to save around 6% of their household income, but it shot up to 18% during COVID. So, so I think, that's another thing, and that people, when they're putting away money, it does give them more spending power for a lot of things. And housing is obviously a benefit, as we've seen, housing has certainly been a beneficiary of that.
The good part about that, it hasn't been a willpower thing. It's just been, what do you spend your money on? You can't book a flight overseas. You can't go and have a beer with your mates. So you might as well just...
Yeah, it's kind of sad. The sad reason that you can't spend money. But...
All right, number 6, record level of government stimulus, including property incentives.
Yeah, so again, things like home builder, we saw that just lead to incredible activity for the house and land sector, particularly from first home buyers. First home buyers have been very active all throughout the pandemic, and partly driven by that 5% deposit scheme, but also helped along by home builder. We've seen a lot of state governments continue on with first home buyer incentives that they would have otherwise stopped, which had a time limit, but they've extended them on, and that's really just helped things along in terms of directly assisting property, but then things like job seeker, job keeper has enabled people to keep paying rent in many cases, keep paying off their loans. So there's been a lot of help, definitely a lot of help from the government sector, which has really helped people through this.
Well, there you go, folks. One of the brightest minds in the country when it comes to property says 6 reasons. Number 1, banks are being supportive for now. Number 2, unemployment primarily impacting renters. Number 3, rental listings have slowed. Number 4 is some economic sectors are faring well. Number 5, less overall spending. And number 6, record level of government stimulus. When I saw you talking about this previously to you and I chatting, you also talked about the risks. It'd be nice to just touch on those to see that there's one main risk, but a couple of minors as well for folks to keep an eye on as we move to 2021.
Yes, I guess the big one is COVID coming back. I think that's, we saw in Melbourne how that derailed a recovery that was moving very quickly back in June. So, thank God Melbourne got on top of it, and it's been, such a relief for everyone living in Victoria that things are going okay now. But, that's really the biggest risk. I think governments, though, really have got a lot more, much better handle on keeping things under control. So I guess, that's a positive. We've got risks still around the unit market in terms of foreign students. That's still an issue as to how quickly they return. We obviously had we've obviously got vaccines rolling out around the world now, but that will take time for that to fully kick in. I don't think Australia is going to open its borders and allow people back in without two-week quarantine anytime soon until that really rolls forward. So that's a risk. And then I suppose which now does seem to be a bit of a retreating risk is, the idea of these cliffs that people have been worried about, that we do know at some point the government does need to withdraw or not tone down, but reduce things like job seeker and job keeper. Banks will have to call in loans at some stage, but certainly at this stage, it's looking like far less of an issue than it was looking back in September. So, I think although it will impact some people, it's not going to be, we're not going to see a mass level of defaults going forward and a high level of mortgagee sales.
Yeah, so stuff to look out for, general, and also, of course, just general risks around, rising unemployment, and if the economy does return back to recession, those types of things as well. But generally speaking, it looks like, and largely driven by owner-occupiers, because a lot of the investors have left the market this year. So clearly there's still that demand, and I guess really highlighted and underpinned by what you said with an unprecedented Super Saturday coming in the extreme shadows of Christmas, which is interesting. Hey, you touched on China-Australia relations before. When we chatted this time last month, I asked you the question around what impact would the American election have on Australia, and you gave the fundamental response of not so much, because China is our biggest trading partner, and that's obviously where most of the impact comes from. Now we're clearly having a little standoff with China. What do you see as the circuit breaker for that? Because clearly we're at a bit of a stalemate, but in the game of who blinks first, clearly we have to blink first, don't we? Because clearly they need our rocks to build their infrastructure. But I think we want to take the moral ground of not imposing reply tariffs on them. However, it's obviously impacting, and clearly with a culture around respect and saving face and all those sorts of things. Can you give us sort of your insights into what you think that circuit breaker might be, and also what it might mean for Australia next year if that sort of worsens to an extent there?
Yeah, look, I think there's some things that they will continue to need to import from us, and obviously iron ore is a big one. And then there's things they don't need to be, which they can play a lot more hardball with. So, things like wine and things like lobster, there's certainly barley, there's certainly issues that are problematic for us, and problematic for us because there's nowhere else really for us to export them to the same extent that we're able to, volume from China. So So, we're not in a totally, we do have negotiating power, so I think, it's definitely the case that China does rely on us for certain products, and we definitely rely on China for certain products, and also services. Obviously, education is a huge one as well. So, I suppose in the end it will be reliance on how well our government can maintain relationships with China. I think the fact that we've had the US election result as it's been is a positive. I think having a more stable global player in the US leadership will be a better outcome. And then, of course, we have had a new trade deal that was announced in November, which will help us from a regional context. So, again, we'll open up a lot of trade routes between other parts of Asia, which will also be of assistance. So, I think at the moment, obviously it is problematic, but, I think in the new year, I think there will be a lot that goes on in terms of improving those relationships, or at least I hope there will be a lot that goes on in terms of improving those relationships.
So from your perspective, your read on it, nothing of major concern here other than the two parties have got to get back to the table and start chatting with each other civilly again.
Yeah, look, at this stage, I think that's what it is. But I think obviously if you're involved in the lobster industry, or you're a farmer producing certain products, or even things like copper mining, which was doing incredibly well, they're the sorts of things that are going to be quite problematic for us. So, I think there's definitely sectors of the economy that will be impacted, but at this stage, it is hopefully that next year we can really start to move forward on a lot of the negotiations.
All right, good insights. Thank you. You have a view on where first home buyer and mining activity is causing an undersupply of housing. Where is that?
So first home buyers are moving very, very quickly across Australia at the moment. So a lot of regional areas, Orange, for example, is one area that we've seen a big drop in houses available, and we have seen a lot of activity from first home buyers. So Orange has just been the star performer this year. It was a complete surprise to see the strength of that market, really partly mining, partly lifestyle, partly first home buyers. It kind of benefited from all things that happened because of COVID.
Makes sense, doesn't it? I did an episode of the show in Orange, and I remember going around seeing the price of housing, seeing the lifestyle that's on offer. It's foodie, it's got great outlooks, but it was just that too far to commute from Sydney. But then all of a sudden, when you have a fringe commutable location like that, sort of have their world opened up by work from home, you can see where the geographical appeal is. And now if they can, the fact that they can marry jobs and be out there, I think it kind of makes sense. I think it really is a beautiful location. Yeah,
it's a great spot. The other areas have been mining areas. I mean, we've seen places like Karratha and Port Hedland, see a reduction in properties. So, I think mining areas are those areas that, although they are now seeing incredible price growth and incredible rental growth, they are areas you do need to be a little bit concerned about in terms of investing there, because they do tend to be very wobbly in terms of their boom bust cycles. They're good places to invest in sometimes, but then other times they're not the best. So definitely mining towns, and then places like Sunshine Coast, Gold Coast, Wollongong, Central Coast, all these fringe areas to capital cities, which I think next year will be, some of the best performing areas, primarily because a lot of people now are being called back into the office, which does make living in, somewhere like Bulli in northern Wollongong, makes it achievable if you only have to go in 3 days a week, but makes living in, somewhere like Yamba a little bit more difficult, because, trying to get to Sydney or Brisbane from Yamba 2 or 3 times a week is quite difficult.
As a Perth boy, I can give you a little tip. It's Karratha, not Karratha.
Oh, Karratha.
The locals.
I'm glad you told me. It was like Launceston. I kept saying Launceston, so yeah. Launceston. Karratha. Okay.
When I first moved from Perth to Melbourne, there's this, as you know, suburb of Paran, but I was calling it Paran. And they said, Rice, you are going to look like an out-of-towner until you start getting that right. So it's Karratha. Just
Karratha, good. Oh, damn, I've been saying it wrong the whole time. But yeah, that's a good insight. Thank you.
You talked about second homes might drive the post-COVID housing. Normally in recessions, the second home is the casualty, but you've got alternate observations.
Yeah, I mean, there's been some pretty big, pretty incredible price growth in a lot of locations where people do buy a lot of second homes. So, I think we've often talked about lifestyle, people moving wherever they want because of the way changes we've made because of working. But anecdotally, there does seem to be a rise in the second home market. So examples being somewhere like Sunshine Beach in Noosa, we've seen that hit well over $2 million. Byron Bay is just, 40% price growth over the past 12 months. If you go to Iluka, just in the Clarence Valley, we've seen that increase by about 26%. And then somewhere like Pearl Beach on the Central Coast has gone up about 45%. So, these areas, they're not all, there would be owner-occupiers and investors moving in, but, it does seem to be, certainly talking to some agents in these areas, that there are also a rise in second home buyers, which makes sense. We are stuck at home for a prolonged period and need to holiday at home, then having a second home makes more sense than it did when we could all travel overseas.
Yeah, it certainly does. Some nice price growth around all of those nice little lifestyle beach locations. Australian shopping centres, how can they avoid US-style mass closures, Nerida?
Yeah, so shopping centres are obviously one of the most challenged commercial property types at the moment. They have been hit by rising vacancies, move to online. There's very quite severe landlord-tenant tensions that have been taking place, store closures. In the US now, we are seeing huge amounts of shopping centres closing. So there's a prediction that, around a third of shopping centres in the US could be closing. So, in many ways, I mean, look, it sounds alarming. It is alarming for the US, but here in Australia, we don't have anywhere near as much retail floor space per capita as they do in the US. They are very well supplied for shopping centres.
It's enormous.
So they've got about twice as many, per square metre, it's more than double the amount that we have in Australia. So, that's going to help us through in terms of shopping centre closures. I don't think that will be an issue, but there will be challenges. It's going to be a lot of work for a lot of landlords to try and get tenants in. There's going to be a lot more work around pop-up shops, those sorts of things. I think for people, obviously most people can't invest in a shopping centre. They are very expensive, but it does also impact a lot of people's superannuation balances. So, it is a little bit of a concern for a lot of people that, if retailers are struggling, if they start to close, and there's this kind of but there is a flow-on effect to the performance of our retirement savings.
Okay, good to know. Last one for me on this sort of regard. Australian luxury prices defy the downturn or the global trend. So, Hong Kong and Paris and New York, they're coming off a bit, but not so here in the luxury market.
No, not at all. I mean, it's interesting. Knight Frank do a report every quarter looking at the top 5% of properties around the world and have a look at what's been happening in terms of pricing. And Auckland has topped the list in terms of the percentage growth. So not surprising, and they have really shut down the virus very, very quickly, and they're operating pretty normally at the moment. But Australia has done well too. So if you have a look across every location in Australia, if you look at those kind of 10 mil plus, 5 mil plus price categories, we really haven't seen a reduction in pricing across the board over the past 12 months. Very different if you go to New York and London, Paris. Hong Kong has been a very challenged market pretty much since there was a lot of issues between China and Hong Kong. So there's things that are happening, and COVID is probably the main one. That anywhere that's been heavily COVID affected, we have seen quite a big hit in the luxury market.
There's a really good lesson for those paying attention to what you just said, because it's not just about the real estate. It's bigger. It's political stability, but it's also having health stability as well. So clearly, New Zealand has smashed it. So and you talked about Auckland topping the chart. So the lesson for the listener here is Australia going forward. I'm of the view that we're about to enter one of the best decades that we've ever had to accumulate property as an investor, and also to improve your net wealth position if you're an owner occupier, because the demand and just the spotlight on our, if we take the telescopic view rather than the microscopic view of the world and see if someone was wanting to pick, where we're stable politically, financially, health-wise, New Zealand and Australia would be well and truly in the top 2 or 3 for them to do that. So beautiful, well said. Thank you for that. Now, let's as we wrap this up, let's turn our eyes to 2021. Now, Ben and I are always talking about the fact that we don't want to make too much generalised commentary because it doesn't help anyone, because we've got inner, middle, outer, and then you throw in apartments and townhouses and detached housing stock. So clearly we can't be too specific. But with a view on 2021, what's your POV, and what are you seeing happening as we sort of come out of much needed break, ticking off 2020 and going into 2021, and how that will impact property next year?
Well, November was a turning point. We had the interest rate cut, we had a vaccine announcement, we had a lot of state budgets. Now, there was a lot that happened. Some very, very, the fact that we're no longer in recession was a big announcement. So certainly what we saw in November was this bounce back in confidence and activity, leading up to this pre-Christmas amazing auction period where we've never seen so many auctions take place in the whole year. That's quite incredible. And then likely we will see a fairly busy January as well. I think a lot of agents will probably continue to not necessarily hold auctions, but given we are seeing so much activity late into the year, there will be some flow through into January, which is highly unusual. Prices are moving. We're already seeing across capital cities that 80% of suburbs at the end of November, we're already seeing price growth. Go to regional Australia, and you're really seeing very similar conditions. That there's some incredible prices being achieved, and that mid-north coast up to southeast Queensland has done well. You've got places like Adelaide, which Unley is seeing incredible amounts of activity on our side at the moment. So across the board, there's just tons and tons of things happening, which I think will, at this stage, certainly is looking like it's going to be a very strong bounce back as we head into 2021. There's still areas of weakness. We've still got problems, as I mentioned Carlton before, we've got similar problems in North Ryde. Anywhere where there's high levels of development and lots of students is going to be problematic. It'll take a while for that to flow back through. But really, I think the areas that I think will do incredibly well next year, and this is partly because of what's happening around workplaces, so there's a lot of people getting called back to work, but also because what we can see in terms of views per listing towards the end of the year is that places like Mornington Peninsula are really seeing incredible amounts of activity. Wollongong, particularly the northern end of Wollongong, Central Coast beaches, anywhere where you can commute in, but don't necessarily need to commute in every day. For most people, are really going to benefit from the situation that we're going forward in 2021.
Folks, I suggest if you get a chance to rewind and listen to that and listen to the detail, because there were so many little clues in the types of things that are familiar in the locations that Nerida talked about. And in my view, if you're chasing established stock and listening to the locations that Nerida's talking about, there are some themes there. And those themes are very much where you could apply across certain parts of the country. But Nerida, what I'm hearing is property sounds like a reasonable bet in 2021 from you, which is good. Hey, I think you're probably sort of wrapping up your professional commitments for the year. So I'm very grateful for the fact that we've had a number of opportunities to talk with you on the Property Couch. I'm sure you're probably just as eager as anyone to sign off on this year, because your commentary has probably been more sought after than at any other time in your professional career. But well done on navigating a difficult and challenging year, despite the headwinds of newspaper headlines, and you often getting, accused of bias because, you're part of a property positivity business. But thanks for your insights throughout the year. I hope you have a terrific holiday season and a Merry Christmas. And from everyone here on the Property Couch, we're excited to chat to you and get your insights in 2021.
Great. Thanks for having me on the show during the year, Bryce.
It's a pleasure. And folks, we are still having our summer series all throughout December and January. We are interviewing some amazing people, so I'd certainly encourage you to tune into that at your leisure as you are taking time off, well-deserved time off over the holiday season. So for those that are celebrating Christmas, Merry Christmas to you. For those who aren't celebrating Christmas, happy holidays to you. And you can listen to us each and every week if you go to thepropertycouch.com.au.